In line with our outlook at the start of the year, most asset classes are performing well as expected. Our previous month edition highlighted key risks from global events and expensive valuations. These risks are now materializing. For India, domestic institutional inflows and corporate fundamentals are the suit of armor against geopolitical conflicts and FII outflows. The conflict between Iran and Israel have caused a surge in crude oil prices. This is a concern for India, as every $10 increase in oil prices negatively impacts our current account deficit by around 0.3% and our CPI inflation by around 0.5%. Due to these geopolitical events, equity markets have also witnessed heightened volatility. In terms of valuations, large-cap stocks appear reasonable compared to their average valuation since 2018. However, mid-cap and small-cap indices are trading at a significant premium to their historical averages. The encouraging factor is that return on equity has improved across all these indices compared to the historical average, which indicates an improvement in the quality of earnings. In recent years, DIIs have increased their ownership of Indian equities, converging with the ownership levels of FIIs. Over the last 2 years, while the FIIs flows have been quite volatile, DIIs flows have been very steady and have provided a cushion against any heavy selling by FIIs. There is a lot of dry powder available with domestic equity mutual funds. As of end of August, equity fund portfolio had an aggregate of 6% in cash, totaling to about 2 lakh crores. This cash reserve could potentially provide a floor to valuations, limiting the downside risk. While earnings growth is slowing compared to the past 4 years, the Nifty 50 is still projected to achieve 13.5% CAGR in earnings between FY24 and FY26. This indicates that corporate fundamentals remain strong. The temperature gauge index remains in the fair value zone. Equity market outlook continues to remain positive based on deleveraging of corporate balance sheets, uptick in the capex cycle and expected earnings to remain steady for the next 2 years. However, given the uncertainties in the global context and rich domestic valuations, it is advisable to tread with caution by adopting a strategy which is balanced and resilient. Based on their risk profile, investors having the appropriate level of equity allocation can continue to remain invested. If equity allocation is lower than desired levels, investors can increase allocation by implementing a staggered investment strategy over 3 to 6 months for large and multi-cap strategies and 6 to 12 months for select mid and small cap strategies with accelerated deployment in the event of a meaningful correction. The US Fed finally began its rate cut cycle last month, and the market expectations are that the Fed rate could go down to as low as 2.8% by the end of 2025. Although long-term yields in India have been on a downward trend since October 2023, they have risen slightly in the past few weeks due to geopolitical tensions and higher oil prices. In its latest policy announcement, the RBI maintained status quo on interest rates but shifted its stance to neutral. The RBI is likely to begin reducing rates in early 2025. We reiterate our view to have a duration bias in the fixed income portfolio so as to capitalize on the likely softening of yields in the next 1 to 2 years. 30% of the portfolio can be invested in actively managed duration funds to capitalize on evolving fixed income scenario. For passive duration allocation, one may invest in long-term maturity GSEC papers to benefit from accrual income and potential MTM gains. 30% to 35% of the portfolio can be allocated to multi-asset allocation funds and equity savings funds. These funds aim to generate enhanced returns than traditional fixed income with moderate volatility through a combination of domestic equity, arbitrage, fixed income, international equity, gold and other commodities. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to private credit strategies, REITs, InvITs and select high-yield NCDs. For liquidity management, investments can be made in floating rate, 9 to 12 months and arbitrage funds, 3 to 6 months. Gold has maintained its strong performance due to 3 main factors. Firstly, it is considered a safe haven asset during times of heightened volatility. Secondly, central banks have been consistently buying gold over the past couple of years. Additionally, gold prices have a historical inverse relationship with the US dollar. With the Fed expected to cut rates, the dollar is likely to weaken, which could further support gold prices going forward.